In this presentation, we'll be talking about the valuation of Apple Incorporated by Adam Sharpor, Damien Hawkins, Chelsea Child, Abraham Afwazan, and Marcelo Mathis. A little bit about Apple. Apple is one of the largest electronics companies in the world. It was founded in 1976 by Steve Jobs, Steve Wozniak, and Ronald Wayne. It has grown to have a market capitalization of $1.5 trillion as of June 2020. Just like any company that is publicly traded on an exchange, investors look at certain ratios and analysis of financial statements to make decisions to buy, hold, or sell securities. Liquidity ratios measure the ability of a company to pay short-term obligations. In this critical ratio that a lot of companies use, two of the most common examples would be current ratios and quick ratios. A high liquidity ratio gives consumers confidence in companies to pay off their debt. A liquidity ratio of 1 or greater than 1 indicates good financial health and can vary by industry. In the information technology IT sector average, the current ratio is usually 1.9 and the quick ratio is usually 1.4. If you look to the left in this slide, you'll see that Apple is in the 45th percentile in their current ratio, which is below the industry average of 1.9. Apple should look into improving their accounts payable and accounts receivable processes, as well as selling off unproductive assets. In the right, you'll see the quick ratio, and you'll notice that Apple is in the 47th percentile in the IT industry, which is right under the industry average of 1.4. One way that Apple can improve their quick ratio is by improving their accounts receivable processes and paying off short-term debt. Another really important value ratio would be the market value ratio. The market value ratio relates a firm's stock price to its earnings, cash flow, and book value per share. The market value ratios help measure the value of a company's stock comparable to that of another company. Examples of market value ratios would be the price-earnings ratio and the price-to-EBITDA ratio. If you notice at the top, you'll notice that Apple's price-earnings ratio is $18.97, which is less than the industry average, and the Apple's price-to-EBITDA ratio is also less than the industry average. This could mean that Apple's are more riskier stock to buy versus other industry competitors because it is a little bit more riskier in terms of the growth potential. Another really important industry ratio would be the asset management ratio, which measures how effectively a firm is managing its assets. The asset management ratios are also known as efficiency ratios, and companies ideally want these ratios to be higher rather than lower. Higher asset management ratios mean that companies are managing their assets effectively, versus lower asset management ratios mean that companies are not utilizing their assets very well. Two important examples of industry of asset management ratios would be the total asset turnover ratio and the inventory asset turnover ratio. If you notice at the top, the total asset turnover ratio for Apple is less than the industry average, which means that Apple may be less effective in managing their assets versus the industry average, which could lower their profitability in the future. Another important ratio would be the debt-to-equity ratio. The debt-to-equity ratio shows the information about the financial leverage of the company, and it is also known to investors as the risk ratio and the gearing ratio. The debt-to-equity ratio shows that how much debt a company is using against each dollar of equity. So by calculating the Apple's debt-to-equity ratio as $1.13, this means that Apple, for every dollar of equity, Apple has $1.13 in debt, which shows that Apple is a levered firm, and it shows a good indication about the cash flows of the company. Another important ratio would be the debt-to-asset ratio, which shows how much debt the company is using against each dollar of assets. Apple's debt-to-asset ratio is 0.3, which shows that 30% of Apple's assets are financed by debt. An important ratio would also be the return on asset, which is calculated by the net income divided by the average total assets. Apple has been unfortunately disrupted by their manufacturing, supply chain, and logistical services by outsourcing partners, which resulted in iPhone supply shortages that affected sales worldwide. The trailing 12-month numbers show a 2.21% gap among industry competitors. The 5-year average showcases the damages produced by the global pandemic of COVID-19 in comparison with past years. Another important ratio would be the return on sales, which is calculated by the operating profits divided by the net sales. The return on sales is a great measure of how efficiently a company is turning its sales into profits. And the return on sales is calculated by the operating profits divided by the net sales. Research does indicate that Apple's operating margin for the last trailing 12 months is higher than the rest of the industry, which is an indication that the company is more efficient at turning sales into profits at the end of the 2019 sales cycle. A higher 5-year average operating margin shows the weight of COVID-19 in the current year in comparison with previous years. Another important analysis that analysts use and investors alike use is the regression analysis, which is a statistical technique used to illuminate a given relationship between two entities. In this analysis, if the beta is equal to 1, there is no volatility. If the beta is greater than 1, volatility does exist, and there is an increase in the returns for the stock. In this case, Apple's beta is 1.14 after the calculation, which means that Apple will outperform the market by 14%, and vice versa during times of economic contraction. If you look at the R-squared number, that determines the validity of the model. R-squared less than 0.5 means not valid. R-squared greater than 5 means that it is valid. In the capital asset pricing management model, it is a financial calculation that is used to determine the required rate of return for every dollar that consumers invest in a company. This is a great calculation that analysts use. Another really important model would be the Gordon growth model, which is used by investors and analysts alike to determine the value of a stock based on the future projection of dividends that grow at a constant rate. It does not consider consumer sentiment, competition, and new products. Apple's current stock price as of June 25th of 2020 is $364.41. This means the projected stock value is less than the stock market number, which means that Apple stock is overpriced. If we look at the Ben Graham model, the Ben Graham model is a calculation of the intrinsic value, which was created by Benjamin Graham, the father of investing. In this model, it uses company factors to determine the intrinsic value, which is the assets, the earnings, and the dividends payout. If the market price is greater than the Benjamin Graham calculation, it should be a sell. If the market price is less than the Ben Graham model calculation, it is a buy. In this case, the Ben Graham model indicates that the Apple Incorporated stock is overvalued. So our final verdict, after a culmination of all of the research that we have compiled, shows that Apple stock should be a buy with a stop of 10%, assuming the market will stabilize. Now, Apple has got a lot going for itself in the next year. For example, the fall debut. With the flagship 5G iPhone and the budget phones coming out, it should be a definite positive for Apple. Another big positive for Apple is going to be the 17% increase in sales revenue that Apple has experienced in the first quarter, as well as the gross profit trends are positive, and the stocks of Apple have increased by 60% from January till now. Now, some things that investors should look for in the future would be Apple stock is overpriced, as determined by the growth model and Graham model. So it's possible that Apple stock could plummet because market prices should revert to its intrinsic value. So thank you so much for your time, and this concludes the project for Apple